Hello and welcome to today's video. When do you rebalance your portfolio? How often is rebalancing necessary for your portfolio? And what are the best strategies and the best time to do it? In this video, we'll see the strategies, the benefits, and the best time to rebalance your portfolio. So stick around, like and subscribe this channel right away so this video can reach a lot of people. Now see, just like you do an oil change or tune up your vehicle, go to a service station for the maintenance of your vehicle, this is exactly similar for the financial world. A rebalance is necessary to tune up your portfolio, to maintain your portfolio's health. So what exactly happens in rebalancing? You buy or probably sell some of your holdings and buy something new to balance out the allocation that you have for your portfolio. The allocation which was initially there in your portfolio, you try and rebalance it back to the same ratio until, of course, your risk appetite finally changes and you make a different ratio for yourself altogether. But till then, you try and balance out and keep the same ratio intact. Now, there are mainly two things in rebalancing. Rebalancing your asset classes and rebalancing your assets. So rebalancing the asset classes. What is an asset class? What is rebalancing an asset class? See, as an investor, you might have invested in 40% in real estate, 40% into the stock market, and say 20% into fixed income instruments. And your risk appetite remains the same. Now, what you should be doing is you should stick to this particular ratio of asset classes. You should remain invested. Your 40% of your money should be remained invested in equity. 40% of your money should be remained invested in real estate. 20% into fixed income instrument. This ratio should remain constant throughout. Now, all assets, they do not give equal returns. You probably know that in falling markets, the bond prices, they go up. The bond market, they give good returns. In, the real estate market is independent of the stock market. They have their own trajectory of returns. They fall under a different perspective altogether. So when different asset classes have different returns, a different potential of returns, you might find after some time, maybe after a year or so, the stock market has given you probably 20% return, 20-25% return. The real estate might have given you a maximum of 5-10% returns. But the fixed income instruments might not have moved up much. So what you do is, the stock market has gone up very high, 20-25% returns you have got. So what you need to do is you need to sell some of your investments from the stock market and put it back into fixed income and into real estates to keep the ratio same as 40-40-20 as it was before. See, when the stock market grew up by 20-25%, now at this point of time, probably you might have a new ratio of, say, probably 50% in the stock market, 30-35% into real estate, and probably maybe 10-15% in fixed income instruments. So if that happens, you need to bring it back to normal. You need to bring it back to 40, and 20. How do you do that? What you do is you sell some of your stock market investments, put it back into real estate, put some of them back into fixed income instruments, and that's how you rebalance it and bring it back to 40, and 20 as it was before. So this is what we call as rebalancing your asset classes. Now, I took an example of just 3 asset classes: real estate, stock market, and fixed income instruments. You can diversify your investments into numerous asset classes: crypto, NFTs, so obviously these 3, and then probably you can go into fine arts and passion assets and whatnot. There are numerous investment opportunities available with us in this country. So if you have, say, 5% of your portfolio invested into cryptos and the crypto market goes up and it takes, and the new ratio forms as like and the new ratio becomes 10-20% of your portfolio into crypto, that is a risky investment portfolio. You should not have it. What you should be doing is sell off your cryptos and bring it back to normal, bring it back to 5%. If you have invested in NFTs, if you have your money into other assets, in passion assets or whatever it is, the main goal is to rebalance everything back to the original formula, to the original ratio that you had, whatever it is. If you have 10 different asset classes and you have set certain percentages on each of them, when they fluctuate, when they go up or go down, sell those, buy more for those that have gone down. That's how you rebalance it. Rebalancing your asset classes. So that was point number one. Now, point number two is rebalancing your assets, each individual asset. Now, what is rebalancing each individual asset? So for example, you take investing in mutual funds or the stock market or in real estates. So in mutual funds, probably you might have 40% in large cap funds or maybe index funds, 40% in mid cap funds and 20% in small cap funds. So if that is your risk appetite, you should stick to rebalancing and keeping that same ratio all throughout the journey. In the falling market, everything goes down. And when the market goes high up, probably you'll find the 20% allocation that you have in small cap funds in your mutual fund portfolio. So suppose you have 100 rupee invested in mutual funds, 40 rupees invested in index funds, 40 in mid cap funds, and 20 rupees in small cap funds. In rising markets, you would find the small cap funds would rise high up. And now at the end of a big bull run, you will find probably the ratio now stands at 30, 30 and 40. So now probably you will find 40% of your mutual fund holding is into small cap funds and just 30% each into large cap and mid cap funds. Now that is risky again, right? Because your risk appetite tells you that you cannot have more than 20% into small cap funds. So what you do is you have to balance out and bring it down to 20%. So sell the remaining 20% of small cap funds holding that you have and push the money back into large cap and mid caps. When you do that, you will find your large cap has become 40% once again, your mid cap has become 40% once again. And now, since you have sold a major chunk of your small cap funds, it's now back to 20% once again. Similarly, for real estates, probably you might have 50% invested in REITs and the remaining 50% into physical properties, something like, a commercial property or apartments or maybe land. So what is the breakup? Probably you might want to keep 50% in REITs because that's relatively much more safer and you do not have to bang your head to maintain that property or look after that property. It's done by the REIT. The other 50%, you probably have a breakup of, say, 20% into commercial properties, 20% into residential apartments, and 10% in land. Now, when that rebalances out, probably you might have to shell out a huge amount of cash and rebalance it back once again, if that is possible. So, yeah, understand, it's not very easy to rebalance, sell off a piece of land or an apartment just like that and buy another one to rebalance your portfolio. It might just take time, but yeah, over a longer period of time, say maybe 5-10 years, if you see the portfolio allocation has gone way up, or it has gone beyond your capacity, you must probably find a buyer and sell off some of your holdings. So yeah, rebalancing your real estate is a tough task because it is not as liquid as stock market investment or mutual fund investments. So finding a buyer at the right time and rebalancing it will not be very much possible at the very spur of the moment, but over a longer period of time, maybe 5 years, 10 years period of time, you might find and bring it back to a suitable position where you can have a peaceful night's sleep, where you can say, okay, fine, now my real estate holding looks good. So that is rebalancing each individual assets in your asset classes. You got an idea of rebalancing stocks, mutual funds. Same with the stocks as well. If you have a certain ratio fixed for large cap stocks, blue chip stocks, mid cap stocks, small cap stocks, do it, rebalance it, and bring it back to the ratio which is very much conducive to you. Same with other asset classes, your passion assets, your crypto investments, or any other alternate investments you have. You need to rebalance everything, every individual asset in your asset portfolio. Now, the third important point is, when do you do it? What is the ideal time to do it? See, there is no set rule as this is the ideal time that I should be doing it. It all depends on how and how much your risk appetite is at the point, at that very moment, and how much you can handle, how much fluctuation, how much volatility you can handle. So in the stock market, when you started, probably you were new, you didn't understand the stock market well, or you didn't understand what mutual funds are. Your income was small and you didn't want to take much risk. It happens for new investors. In early 20s, your earning is less and you fear of losing that small amount of money. Although we recommend do put in a good amount into small cap funds, probably, take more risk because you're young now. You should take more risk to give a boost to your portfolio, but it's human behavior. Some people just cannot take risk. So if that is your situation early in your life, you might have invested 50% into large cap index funds. And then with time, like maybe 5-6 years down the line, 10 years down the line, you have understood the market, you have been in the market for 10 years, you have understood, you have seen the volatility of the market, you have seen how the market performs. And then you now have the confidence, you now know, okay, fine, I am just 27, 28. I have seen the market for 7-8 years now. I really understand what it is and how it works. I can take on more risk. So let me put in 50-60% into small caps. Now, by that time, your initial portfolio, which had 50% of your money invested into large caps and say probably 10 or 20% into small caps because you were really afraid of the market. Now, when you're not afraid of the market and the market in the last 7-8 years have performed well, now the market has already given you a good return and your small cap portfolio now reflects 50% of your total market holdings. Your large cap portfolio probably holds 20% and the remaining 30% in mid caps. This may be a very suitable ratio for you at 28, 29, when you're still young, into your 20s. You might say, fine, I'm very much okay with 50% into small caps. Well then, if that is the case, there is no need for rebalancing. So it depends on your risk appetite. It depends on how and what you want to do with the market scenario, what you want to do with your holdings, how much risk you can take. Similarly with real estate, if you are not comfortable with high ticket purchase, maybe a purchase of land or maybe a purchase of apartment or commercial property, developed properties or something like that, and if you really want to have all your money into REITs, that's fine. And probably you might have one small apartment and one piece of land or one piece of commercial estate. That's it. The entire holding of your real estate probably might reflect 70-80% into REITs and the remaining 30% into these three physical investments into commercial property, apartment or land. So if that is the case, that's fine. Maybe 20-30 years down the line, you still have the same risk appetite on your real estate investments. That's absolutely okay. You can keep the same ratio. So that's when and how you should be rebalancing. But for the stock market investments, the government gives us an exemption from taxes for the first 1 lakh returns that you get from the stock market. So many a times we do advise to rebalance your stock market portfolio, stock mutual fund portfolio once every year. That is an advice, but if you still feel it's good, I'll tell you a trick what you should be doing. Once every year, sell off your positions, square off, and rebalance your stock or mutual fund portfolio. Do it irrespective of the risk appetite you have. The reason is, you get to capitalize on the 1 lakh rupee tax exemption that the government has given us. What it does is, when you sell off some of your portfolio holdings, stock portfolio holdings, within the limit of 1 lakh profit, you do not have to pay taxes on it. So, you sell off and buy the same asset immediately at the same price. So, effectively, you're not rebalancing at all. Or if you really want to rebalance, you can do it. So, either way, you sell off and buy some of your stock holdings or mutual fund holdings. While doing this, you take the advantage of the tax harvesting. And yet, if you want to rebalance, your rebalance happens automatically. If you do not want to rebalance, you just simply take the advantage of tax harvesting while keeping the portfolio allocation intact. The compounding remains intact. Nothing changes. You just save on that 1 lakh, save on the taxes on that 1 lakh profit. That's about it. So that's all for today. Rebalancing is a task which is solely dependent on you when you want to do it as per your will and comfort. But it's really advisable that you constantly monitor the market, you constantly monitor your investments to see how they are performing. Anything not performing well, definitely it's time for you to move on. Definitely it's time for you to sell off that investment and buy something else. That's all for today. See you again in the next video. Till then, SC signing off. Goodbye.